Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on Sunday, June 25th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's get to that. Google recently introduced a new set of tools that they believe are far superior to traditional methods in detecting money laundering activities on a large scale. Google Cloud marked the launch of their Anti Money Laundering AI, or AML AI service. This service was successfully tested with HSBC. HSBC is a financial services group based in London. AML AI employs machine learning to generate risk profiles, oversee transactions, and scrutinize data. As per a blog post from Google Cloud, AI transaction monitoring is set to replace the old, manually defined, rules-based approach. It leverages the data of financial institutions to train sophisticated machine learning models, offering a comprehensive perspective on risk scores. During the trial phase with HSBC, Google Cloud reported that the number of positive alerts increased by 2 to 4 times. They also reported a significant reduction of 60% in false positives. The cost of using the service will be determined by the number of customers who use the AML and risk scoring systems daily and the number of customers included in the training data set that's used to initiate the model. The introduction of AML AI clearly indicates Google and Google Cloud's growing ambitions in the fintech sector. While the current focus in AI is on generative AI products like their Bard chatbot, Google has been subtly establishing itself as a fintech developer and a provider of banking services. During the pandemic, Google quickly rolled out a Paycheck Protection Program loan processing tool. Over time, the company has explored alternative payment solutions, including the widely used Google Pay service and Google-sponsored debit cards that feature near-field communication technology. Google's increased involvement in the AML sector could be a positive development for the industry, which is experiencing growth. A study by Blue Weave Consulting estimated the global AML market size to be around $3 billion in 2022, and they expect that to nearly triple to $8 billion by the end of the decade. This growth is attributed to the emergence of non-traditional payments, evolving regulatory frameworks, and a consistent rise in the number of money laundering cases worldwide. Speaking of advancements in the fintech sector, let's move on to the recent legal victory for a major player in the crypto world. But before we dive in, don't forget to like, follow, and subscribe to stay updated with all the latest crypto news. In a landmark decision, the U.S. Supreme Court has given the green light to Coinbase to pause customer lawsuits. This move allows Coinbase to focus on the appeals that aim to shift these disputes from the courtroom to private arbitration. This decision was supported by 5 out of the 9 justices. It reverses a previous ruling from a lower court. The case in question involved a user who took legal action after falling victim to a scam that resulted in a loss from his account. Coinbase's goal is to push for arbitration in response to a potential class action lawsuit that has been filed against them. While this ruling is undoubtedly a victory for Coinbase, it does not necessarily affect the broader cryptocurrency industry. It's really not even a crypto case. It's more of a case on arbitration and process. That said, it is worth noting that this is the first instance of a cryptocurrency company making its case before the Supremes. This could set a precedent for future lawsuits involving Coinbase or other companies in the industry. Now think about it. If some other legal disputes that Coinbase is currently going through end up going to the Supreme Court, which they very well might, at least Coinbase's attorneys will have been there before. This can be an advantage. Arbitration is often the preferred route for businesses when dealing with claims. It's typically faster and less expensive than court litigation. Moreover, arbitration can be a less daunting battle as it carries a lower risk of substantial damage. Following the Supreme Court's decision, Coinbase can continue its efforts to enforce arbitration. The 2 lawsuits that were dismissed involved Abraham Bielski, a customer from California, and a group of former users. Bielski alleged that a scammer stole over $30,000 from his account last year. He said that this is a claim that Coinbase failed to investigate or refund, violating the Electronic Funds Transfer Act. And as far as the other case goes, Coinbase had a contest centered around Dogecoin prizes. So this group of former users is accusing Coinbase of misleading them into paying to participate in that sweepstakes. They claim that the contest violated California's false advertising law. In both cases, Coinbase appealed earlier lower court decisions that ruled against their argument for arbitration. This positive development for Coinbase comes at a time when the exchange is facing challenges from U.S. regulators, particularly the U.S. SEC. The Securities Exchange Commission recently filed a complaint against Coinbase, accusing it of operating its crypto asset trading platform as an unregistered national securities exchange and broker. Following this lawsuit, Coinbase received show cause orders from 11 U.S. states, requiring the exchange to explain why it should not halt operations in those states. From the courtroom to the trading room, now let's turn our attention to a scandal involving a bankrupt cryptocurrency lending platform. Claims have been made by executives from Celsius that Wintermute engaged in a practice known as wash-trading. But there is an interesting twist. This was allegedly done to manipulate trading volumes on the Celsius platform. The creditors of Celsius Network have accused the crypto market maker of helping manipulate the price of Celsius through improper market trading. A recent court filing, cited in a June 23rd Bloomberg report, reveals that Celsius creditors have updated their lawsuit in the U.S. District Court from the District of New Jersey. They now allege that Celsius executives engaged Wintermute in wash trading. Wash trading is a deceptive form of market manipulation. It creates the illusion of higher trading volume for a particular asset than truly exists. Wintermute is accused of helping Celsius CEO Alex Mashinsky and other executives to manipulate and profit from the illegal wash trading of unregistered CEL tokens. The creditors claim that both the Celsius executives and Wintermute knew what they were doing was wrong. The lawsuit alleges that Wintermute and the Celsius executives participated in a scheme that artificially inflated the trading volume of the CEL tokens sold and marketed by Celsius. The alleged scheme was discovered through publicly available internal conversations between Celsius executives. It's also claimed that Celsius executives involved Wintermute in these improper market-making activities from around March 2021 until Celsius froze withdrawals in June of 2022. Reports suggest that Celsius had no measures in place to prevent improper market-making. The supposed controls were virtually non-existent, and those that did exist did not monitor for or protect against wash trading or self-dealing. In related news, on May 25th, it was reported that Fahrenheit was the successful bidder to acquire the assets of Celsius, previously valued at $2 billion. They obtained the Celsius Network's institutional loan portfolio, staked cryptocurrencies, mining unit, and all their alternative investments. This acquisition comes almost a year after Celsius initially filed for Chapter 11 bankruptcy in July of 2022. While we're on the topic of legal disputes, let's take a look at a recent clash between a digital artist and a luxury fashion house. And remember, if you're enjoying the show, make sure to like, follow, and subscribe for more crypto insights. The creator of MetaBirkin, one Mason Rothschild, found himself in a legal tussle with the French luxury house Hermes. Rothschild argued that his project, which involved creating non-fungible tokens of Hermes's iconic Birkin bags, was a form of artistic expression protected under the First Amendment. However, his defense did not hold up in court. Hermes initially approached the U.S. District Court for the Southern District of New York in March, seeking to halt all sales of the MetaBirkin NFTs. The court, led by Judge Jed Rakoff, sided with Hermes, issuing a permanent injunction against all MetaBirkin NFT sales. Judge Rakoff expressed skepticism towards Rothschild's defense, suggesting that Rothschild project was misleading consumers into believing that Hermes endorsed the MetaBirkin NFTs. The MetaBirkin collection, consisting of 100 NFT artworks, has reportedly generated over $1 million in sales. The legal dispute started in January when Hermes accused Rothschild of improperly using its Birkin trademark, leading customers to believe that the brand was supporting the project. In February, the court ruled that Rothschild had violated Hermes trademarks. A 9-member jury delivered the verdict, and Rothschild was ordered to pay $133,000 in damages. Now, Rothschild argued that the project was an artistic expression protected by the First Amendment, similar to how Andy Warhol was legally allowed to make and sell art featuring Campbell's soup cans. Rothschild also claimed that he hadn't explicitly misled customers, as he had provided disclaimers explaining that Hermes had no affiliation with the project. However, the judge and jury disagreed with the claims. They found that his use of the word Birkins in the name and the design of the MetaBirkin's NFTs was explicitly misleading and rejected his disclaimer defense. Now, from the world of luxury fashion to the world of Ethereum, let's now discuss a recent short position initiated by a savvy trader. One user has leveraged Aave's version 2 lending platform, depositing 7.5 million USDC as collateral. This move comes in the wake of Trust Token's decision to temporarily stop the minting and redemption of its True USD stablecoin via its banking partner, Prime Trust. Apparently, this trader saw this as an opportunity and initiated an on-chain short position. Data from the blockchain shows that the Ethereum user then borrowed 4 million TUSD and quickly exchanged it for USDC. This method of borrowing and then immediately selling is a common tactic used to create a short position on a specific asset. Earlier this month, the True USD team made the decision to stop the minting of new TUSD through its custodial partner, Prime Trust. Following this, the state of Nevada issued a cease and desist order to Prime Trust. The issuer of True USD responded to the situation with Prime Trust by clarifying that it doesn't impact their operations related to the conversion of fiat to stablecoin and vice versa. In a statement, the issuer confirmed that it has no exposure to Prime Trust and continues to maintain multiple US dollar rails for the minting and redemption of True USD. So what happened is, BitGo did to Prime Trust what Binance did to FTX. BitGo provides wallet infrastructure and data asset custody services. They previously expressed interest in acquiring Prime Trust, as indicated by a non-binding letter of intent announced on June 8th. However, on June 22nd, BitGo shared on Twitter that they decided to withdraw their intention to acquire Prime Trust. In related news, Circle and Sequoia were among the top depositors at Silicon Valley Bank. The New York Department of Financial Services and the US SEC took legal action against the Binance-branded Binance USD stablecoin and its issuer Paxos Trust. After that, Binance decided to replace its BUSD holdings with TUSD. This led to a significant surge in the usage and popularity of TUSD. TUSD is the current fifth largest stablecoin, following Tether, USDC, DAI, and BUSD. It has a market cap of just over $3.1 billion, according to CoinGecko. As we explore the fascinating world of crypto, don't forget to like, follow, and subscribe to stay in the loop. Now, let's move on to our final story for tonight. A creditor of the now bankrupt cryptocurrency exchange FTX used a claim worth $31,307 as collateral for a loan in the decentralized protocol Arcade. According to Bankruptcy Claims platform Found, this marks the first instance of an on-chain loan being backed by an FTX claim. The claim was tokenized as an NFT that represents the ownership of the claim. On June 23rd, this NFT was used as collateral for a loan of $7,500, which is due to be repaid within 5 days. If the borrower fails to repay the loan, the lender will have the right to the claim. This transaction is a demonstration of the tokenization of real-world assets. That's a process where a blockchain digital token represents a physical asset's ownership rights. In DeFi, the tokenization of assets is a significant trend, with a variety of real-world assets including stocks, government bonds, real estate, and commodities being tokenized. The original creditor and lender underwent biometric Know Your Customer and Anti Money Laundering checks as stated by Found. As per Found's website, it enables users to obtain loans using bankruptcy claims as collateral, charging a 10% transaction fee on successful trades. FTX filed for bankruptcy in November of 2022. This resulted in billions of dollars in users' accounts being locked for court proceedings. Some estimates suggest that holders of FTX claims could recover between 35 and 66% of their face value. This past year has seen a surge in crypto-related bankruptcy cases, many of which are linked to the collapse of FTX, including cases involving crypto firms Genesis Global Trading and BlockFi. This increase in bankruptcy filings has led to the development of on-chain claim solutions. For instance, Found was launched at the start of this year, and co-founders of the defunct hedge fund Three Arrows Capital introduced the claims trading platform Open Exchange in April. So what happened? We covered a lot of ground, so let's take a moment to recap. We kicked off the show with Google's new Anti Money Laundering AI service, a significant leap in the fight against money laundering. This AI system, tested with HSBC, has shown promising results, increasing positive alerts and reducing false positives. Google's move into the fintech sector could be a game changer, especially as global AML market is expected to triple by the end of the decade. Next, we discuss Coinbase's victory at the US Supreme Court, a landmark decision that allows the crypto exchange to pause customer lawsuits and to focus on appeals. This ruling could set a precedent for future lawsuits involving crypto companies, making it a significant moment in the crypto legal landscape. We then delved into the allegations against Wintermute, accused of helping the now bankrupt Celsius network engage in wash trading. This scandal underscores the importance of transparency and integrity in the crypto industry. Our fourth story took us to the world of NFTs, where MetaBirkin creator Mason Rothschild faced a legal battle with luxury fashion house Hermes. The court sided with Hermes, halting all sales of MetaBirkin NFTs and highlighting the legal complexities surrounding NFTs and intellectual property rights. We then moved on to a trader who shorted TUSD for $4 million on Aave's V2 lending platform. This move, prompted by Trust Token's decision to temporarily stop the minting and redemption of TUSD, demonstrates the agility and opportunistic nature of the crypto trading world. Finally, we discussed a unique case where a creditor of the bankrupt cryptocurrency exchange FTX used a claim as collateral for a loan in the DeFi protocol Arcade. This marks the first instance of an on-chain loan being backed by an FTX claim, showcasing the innovative ways that blockchain technology can be used. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.